This is a presentation I put together for discussions at the IMF meetings and so on. What I wanted to present here is what to expect for Latin American economies going forward. We all know that the golden years are over. Golden years meaning soybean prices at $300 per ton. Now it's around 30% less, was even lower, 40% less. So it's not going to be easy. We always put as an example, it's very easy to cruise when you have headwinds, but it's very difficult to sail when you have really the wind coming and headwinds actually coming in the front. So it's very difficult to advance. So all the social and economic advances that most of the economies in Latin America really got during recent years is not going to be easy going forward. So let me introduce, we're going to see what is going to be the growth overview, what has been the growth overview for Latin American economies recently. Then I'm going to discuss a little bit about what we can do in order to continue to perform well. And then finally, some remarks and conclusions. So let me start first with what has been the trend for Latin American economy. And of course, most of the economy after a long period of time became richer. If you look GDP per capita in constant US dollar or GDP per capita adjusting for PPP, Latin America, and this is the average of Latin American economies, is much richer than the countries were in 1980. Some 35% richer. Now, that was good, that was average, that was really bad, because it's good for you to become richer over time. But the real objective for policymakers is to become richer than the average over time. It's not enough for you to become richer. So what we did was to start comparing, okay, this was a great advance for Latin American economies by itself, but what about if you start comparing with the US per capita income? And then the picture is not that nice. Here you have what has been the dynamics of the per capita income relative to the US. And look at the picture on the left. You see emerging and developing Asia. You started in 1980 to see what had been, at that time, per capita income compared to the US per capita income in Asian countries. And look at what has been right now, at the end of 2017. You can see a strong advance during this period. If you look at Latin American economies, this is the black line. We started in 100 in 1980, and right now we are even lower than at the time we start to see the pictures. That one you can see here again. You see advanced economies relative to the US, roughly constant. This means 80% of US income, per capita income. So roughly constant during all this period. For developing Asia, look, was only 4% of US per capita income, and right now it's 19. And for Latin America, and this is the bad part, if you look in the 80s, Latin America and Caribbean on average was 36% of US per capita income. Right now is 26. So the nice picture we had before, that we became richer, actually is a good thing. But relative to what others have done, it's not that nice. It's like the soccer team that win a lot of matches, but at the end other teams won more matches. So it's not the champion. So we always have to start comparing with what other people were doing. Just something aside. We always said that it's not something virtuous to grow when everyone else is growing. What is important is for you to grow when the region is decreasing. And that is an example we always use for Paraguay. During the golden years, everyone was growing at 4.5% more or less. Paraguay was growing also. But what is really good is when your economy can grow despite the fact that all the region was contracting, like what happened during the recent 5 years. So Latin American, relative to US or relative to other regions like Asia, didn't do well during the last 30 years. One other thing is that if you start looking at what were the sources of growth during recent years, you can see that for Latin America, the reason for growing was totally different from Asian countries. Look at something that we always, and you probably always heard about, total factor productivity. I mean, it's good to have more machines, it's good to have more people working, but what really makes all the countries growth in the medium to long run is productivity. So if you look at the numbers for Latin America, see here, increases in GDP, this one here, the blue one, basically explained by a sharp increase in investment. Let me highlight something. This is the time of the commodity boom prices. So what happened in Latin America in recent years was that a lot of investment went to Latin America due to the high commodity prices. So we have a sharp increase in investment, more capital. Some increase in employment, probably reflecting also what is the demographic boom that Latin American economies are going through at this moment. And look at how dismal is this picture. Latin American productivity. I mean, it's like an airplane start taking off and then going to ground again. Look at the picture in Asia again. The same. GDP growing up, same period. But now you can see Asian tigers, TFP, going up. Of course, also investment and also employment also. But this is a more balanced growth, mainly explained by 3 factors, not only basically one factor that is investment. That means that is totally correlated to also commodity prices. So this is much less sustainable than this type of growth. So 2 bad things already. Latin America grew, but not enough relative to other regions. And the quality of economic growth is totally different from the one we want to see, that is increasing in productivity. These are 2, the same. It's the same, but these are 2 studies. One is from the IMF, is here, and the other one is from the World Bank, and the same. Look at only here, the green bar is regarding total factor productivity, negative between 90 and 2002, and slightly positive between 2003 and 12. And here the same. If you look at total factor productivity and you look, the lowest one probably is Latin America. Look at what is emerging Asia. What is the growth rate? 0.4%, and here is 0.1%. So it's 4 times better. And in the US, economic growth is basically, given that they don't have any demographic boom, the growth rate is mainly explained by TFP. So the quality of economic growth was also very bad for Latin American economies. Another bad thing, I'm sorry, today is Monday, was a good weekend, but it's Monday, so I'm not that optimistic. Latin American growth is highly commodity dependent, commodity price dependent. Look at the picture, it's incredible, the high correlation they have. When commodity prices is in a boom, you see a strong Latin American growth. When you have a collapse, like in 2008, 2009, you see a collapse in Latin American growth rate. The same happened recently when we have the drop in commodity prices starting in 2014, 2015. So highly dependent on commodity prices, and this is the thing that I mentioned before. Real private investment and export price growth. Export price growth is basically commodity price growth. And you see again, very high correlation on real private investment. So, not enough, bad quality, and highly dependent on something that is totally exogenous. So this is not the place we want to be when talking about economic growth in any country. This dependence on commodity prices also put a strong volatility in GDP growth rate. If you look at the export of commodity in different regions relative to total export, Latin America is by far the one that is most dependent on. So around more than 30% of total export are basically commodity export. And that induced to, given that commodity prices are quite volatile, that induced a quite high volatility in Latin American growth rate. Just to mention something, what does it mean to have this standard deviation here of assume it's 2.2? If you have an average, like for Latin America probably is, say, 4% growth rate. If you do the statistic, a 95% confidence interval, and I hope you know that, is where the growth rate can fluctuate, is basically 2 times that. It's 4.4%. So Latin American, if you consider the average is 4%, could grow as high as 8% or as low as 0%. So in any of those numbers, that is a normal year for Latin America. Imagine the volatility, the extreme volatility that we're having in economic growth in Latin American economy. So this is huge. I mean, this is you cannot consider it's only 2.2% growth rate. This is really +4 -4. So the difference 8 is huge. So extreme volatility that is not good for anyone in our country. And more recently, happened that always happened. I mean, you have the good cycles, you have the bad cycles. And then recently we have been affected by several external shocks. Just to mention 4 of them, commodity price that went down. As I mentioned before, 40% drop in soybean prices. It's the one I know because we export soybean prices, but if you look at other commodity prices also was the same, with some recovery at the margin recently. You have an increase in risk aversion recently. Look at, this is MB for Latin America, and you see the average used to be less than 400 basis points, and right now it's more than 500 basis points. This is huge. So this means much expensive financial conditions for when we are issuing bonds abroad. An appreciation of the US dollar, even though at the margin we see some depreciation of the US dollar, but this is totally different from what used to be when the commodity price boom. And also the funds rate going up, and this is the basic for everyone. On top of this, we have to price the, I don't have the bigs here, but you have to price over to any issuance of bond that you have. So several external shocks that has been affected Latin American recently. And this has led to a significant slowdown in growth rate. As I mentioned before, golden years are over. You see what has been the deceleration, and this is a deceleration across the whole world. But look at the sharp deceleration in Latin American economies, from almost 5% to 1%. This is a sharp deceleration. In advanced economies, they were not growing that much. They decelerate, but the decrease was not that big. And the deceleration was across all the region. Any of them. The exception, good, I'm talking here so I can show. Look at Paraguay. It was different. That's why I want to talk a little bit about what we have done in Paraguay for some other stuff in order to avoid the sharp deceleration we have before. Brazil, Argentina, Venezuela is not entering here. I mean, it's going to be down there probably. So really, all the regions, and if on top of that you have very bad domestic policy, the deceleration is even more. So, having given you the picture, okay, what to do going forward, because it's very unlikely that we're going to go back to the golden years. We cannot rely anymore on exogenous factors in order to grow. We cannot rely that more investment will come and that is going to push the growth rate. We need to really focus on productivity. I remember during one of the final conferences, we always do an annual conference at the end of the year, and there was a section in my presentation saying productivity, productivity, productivity. And that is the time when I start discussing about what Paraguay has to do in order to really, we didn't do that bad. Eh? Remember, we didn't suffer the deceleration of other countries, but going forward, we really need to work on increasing productivity. And for that, I put it this way, that I think I consider is easy to remember. The 5 I's that we need to focus. One word of caution. It's very difficult always to give a single recipe for all the countries. Everyone is different. And that's the reason why I like here at CID when they do the growth diagnostic, because the bottlenecks is different from country to country. But in any case, I cannot stay here or to talk for the different Latin American countries and the countries in the Caribbean, because it's going to be 20 more countries and I'm going to finish in an hour, or I cannot stand in front of you and say, I cannot say anything. So I decided to say something that mostly applied to several countries in the region. And these are the 5 items that I really doubt that anyone will say, no, we don't need that. Coming from any country in Latin America, I don't see any person saying, we don't need investment, we don't need institution, we don't need more integration, innovation, or inclusion. So let me talk a little bit about all these 5 I's that I think are going to be crucial going forward in order to deliver a stronger growth rate in Latin American economies. Let's talk first about public investment. If you look at the infrastructure in the region, infrastructure is really of poor quality. Look at here, that is the, oops. This is the quality of Latin American, let me put on the side. Latin American compared to other regions by the World Economic Forum. The blue one, very bad quality. Of course, if you have something that is in very bad condition, your house, you need to start increasing the quality of the house. And to do that, you need what? You need to invest. The problem is that we have a poor quality infrastructure, and also, at the same time, we're investing much less. Emerging nations have a much better quality of infrastructure and still invest much more in terms of GDP than Latin American economy. So there is no way that you can really improve this quality if you're not investing. And we are not investing enough. Or at least we're not investing at the same level as those countries in emerging Asia. And you may ask, okay, why we're not investing? What could be the problem? And let me highlight some of the problems we are seeing. One, public investment. You have 2 levels: private investment, public investment. Let's talk first about public investment. What happened recently, since that many fiscal situation in Latin American countries depended so much on commodity prices, when those prices dropped, what happened was that we started to see a sharp increase in fiscal deficit. So, no much room to spend on more public investment. What is worse? The governments in Latin America were becoming poorer over time because they had less revenue, and they started to misspend the few money they had. Look at the sharp increase. This is the share of capital and current spending in total spending. Look at current spending, basically salary. They used to be around 68% back in 2008. Right now it's more than 80%. So instead of spending on public investment, they started to increase the share of current spending, salary, wages, more employees. And what happened with infrastructure went down sharply. Look at it. Was around 30% back in the 80s, and right now it's less than 20%. So this is bad quality of spending, because you are not really doing your work as a policymaker, because public investment is good in the short run, because create more jobs. But create more jobs that will be important to build the infrastructure, that will have an effect on the growth rate in the medium term. So that is the problem on the public side. We have less fiscal space to spend, and on top of that, we were spending very badly. On the private investment, we don't have enough saving. We don't have enough saving. If you compare, look at here the relation, the strong relation you have across any region, in this case Asia and Latin America, between the savings rate and the investment rate. It's very close. The two lines are very close for the two regions. Now, in terms of GDP, savings in Asia could be as high as 40% of GDP. In Latin America, it's around 20%. So that's the reason why we are having around 20% of investment, total investment in Latin America. So we need to save much more, especially because now we have a demographic boom. Could you imagine when all these people retire in the future, how they're going to be financed, the pension of these people who are now 20, 30, 40 and working? If we're not saving enough today, it's not only bad for investment today, but it's also going to be very bad for the fiscal situation in the future. And we always say in Paraguay, we're not only saving very little, but the pension system is so badly designed that actually is using the few investment, the few saving we have is being invested in a very bad way. Just to mention something, the largest pension fund, that is the state-owned pension fund, used to have around 80% of all the funds in checking accounts. Can you understand that? I mean, they have liabilities that are medium to long term, and they were having all the assets in short term, I mean overnight basically. That's a very bad way to save. Now, private investment, not enough saving to fund all the investment we need. And on top of that, who is going to be the intermediary between those who save and those who invest? The financial sector. And you start looking at what is the relative size of the financial sector in Latin America vis-a-vis other regions in the world, and it's very bad. It's less than 50% on average, while in other regions it's 100 or more than 100% of GDP. Of course, I'm not calling to go to the case of Iceland, where they have something like 700% of GDP, and then the financial sector collapse, and then the fiscal collapse also. But I'm just mentioning that 50% is too low. So with a very small financial sector, we don't have really an efficient way to canalize any saving we have into productive investment. Now, let me mention here what we did in Paraguay. Remember that we were able to really stabilize growth rate. And one of the important part was fiscal policy over there. Like in other countries, we saw, and this is a public investment, current spending by the government. We saw an increase in current investment up to 2013. And slightly lower public investment up to 2013. And then we saw the sharp drop in commodity prices, and we need to do some counter-cyclical fiscal policy at the time. And we forced, and actually we freeze all the wages at the public sector. And that's the reason why we have, and cut some non-necessary spending also. And that's the reason why we saw something that was increasing, current spending, to decrease over time. That created room for us to start increasing again public investment over time. Public investment in Paraguay at the central government, this is total government, at the central government was less than 1% of GDP. Last year was 3% of GDP. The fiscal deficit last year was 1.5% of GDP only. So more than 100% of the fiscal deficit is explained by public investment. That's different from other deficits, for example, that you see in the region. You can see in the region, for example, the case of Brazil, that is, I think, is around 8 to 9% of GDP, fiscal deficit, with public investment only of 1% of GDP. So this improvement in the quality of the fiscal spending was crucial for us to sustain the economic growth in Paraguay. Now let's go to the second thing, institutions. An institution is quite broad. We were talking on Saturday regarding corruption in Latin America, and I think was across the whole region, corruption is a main issue at this moment. And I mentioned during that we really had some improvement in, we had some improvement on macro institutions recently. During the 80s, a collapse of 40% in commodity prices would mean sharp crisis in Latin American economies. And that was not the case right now. I mean, macro institutions, I mean, fiscal policy and monetary policy are much better right now than during the 80s. We cannot rely. Of course, there's some room for improvement, and I don't need to mention what I mentioned before, and I need to update because this is very low. The 2,500% inflation rate, and for this year is going to be bad. And you see the fiscal balance, this is roughly okay, but some countries still need to adjust. Venezuela, Brazil, Bolivia, Argentina, they all need to adjust still the fiscal policy. But if I have to look on average, I would say macroeconomic institutions in Latin America are doing okay. Now, where we are very weak are in micro institutions. Doesn't matter if you look at the rule of law index here, or if you look at the quality of institutions done by the Global Competitiveness Report, we are always behind other regions in the world. So we need to improve this quality of institution, and this is not only corruption or transparency index. Corruption is true, it's one of the biggest concerns in the region. If you look at the distribution of the index, only Chile, Costa Rica, and Uruguay are doing quite fine. All these are other countries. And then all the other countries are doing quite bad compared to other regions. So institution is something that we will need in order to deliver a stronger growth rate in the future also. We don't have to focus only on the macro part that are quite fine at this moment. We need to start working on micro reforms, in reform of the second generation at this moment, no more about fiscal responsibility law or independent central bank. Now we need much more than that. So what we have done in Paraguay during recent years, we passed a fiscal responsibility law. Recently we reformed the banking law. We are on the process of reforming the central bank law. Actually it's going to be the Senate, is going to be discussed at the Senate this Thursday, the central bank law. And we have also a pension law underway. So we were working also on the macro part. And on the micro part, we were taking many steps towards improving what is the perception of corruption and the perception of transparency at the government level. So we are working on that, and hopefully all these reforms that we are doing will have an impact also on improving the institution in Paraguay going forward. Now let me go to another integration. And integration is, if you look again at trade integration, we're not like negotiating I was surprised that this was not only the case of Paraguay when I heard that Colombia, for example, is trading 30% of total trade is with the US. Okay, fine, it's a power economy. But then only less than 10% is with Brazil, that is next door. So how can you explain that you have something that is, because on trade, it's very important the logistics cost, transportation cost. And then you're trading or are able to trade more with some countries that are far away, like in the case of Latin American economies, China, and you're not trading with others who are in the neighborhood. So we are really very bad situated in terms of intra-regional trade. That is one of the lowest. Look at, for example, in the European Union. And here we have many trade agreements. Mercosur, you have also the Pacific Alliance and so on. But despite all, and Central America also has a trade agreement. But despite all the agreements, we do have a very low trade between the regions. So we need to do something here. Is possible? Yes, there are very large opportunities for more trade in the region. What happened with Mercosur was that we put into a trade agreement countries that are very alike. It's like having the best forwards in soccer, and you don't have any defense, any goalkeeper. So you play with 11 forwards. That's not going to be good. You're going to lose all the games. So in Latin America, if you look at the production table, or if you look what all the countries in Mercosur are producing, most of us are selling commodities and food. But if you look at the Pacific Alliance, you see the 10 main export here, 10 main export there. There are very large opportunity for trading here between these two, for example. And that is something we need to explore. We are too much alike. It's true that here they have also some commodity export, but those commodities are different also from these commodities here. So we have a lot of room to exploit to deepen the integration between blocks. We're now negotiating with the European Union, and hopefully by the end of this year we're going to have an agreement. This is going to be great, because probably it's going to be the most successful agreement for Mercosur countries to achieve, and will also open the door to negotiate with the Pacific Alliance. But this is not a regional trade. This is an extra-regional trade. I think that we have a lot of room to really explore more trade within our region. And here, on financial integration, that is another part, there is very little integration between the financial markets. And now improve a little bit more. Why? Because all the demands here in the US for controls on anti-money laundering and combating terrorism imply that many banks in Latin America left the region, and the empty space was filled with regional banks. That's the only good thing that happened recently on the financial sector in Latin American economies. But still, it's not possible still, for example, for the Paraguayan economy to go and issue bonds or to issue shares in Colombia or in Peru and vice versa. So we need to deepen really not only trade integration, but also financial integration is going to be important for our countries to strengthen growth rate going forward. The fourth I, innovation. And innovation, if you look at research and development in Latin American economy, very poor, very basic, nothing. If you look at the level of total patent applications in Latin America, look at that. And concentrate in a few countries, Brazil, Colombia, Mexico, not much. If you look at patents per 10,000, 100,000 inhabitants, again, same. Only Brazil, Chile, something. but nothing compared to the US, Canada, Spain, and so on. So, are we doing really research? Are we really focusing on putting money in order to increase productivity? Because innovation means more productivity, and we're not doing enough in order to increase productivity over time. Look at research and development spending as a percentage of GDP. These are the leading countries, almost 3% here, more than 4% here, and Latin America, less than 1%. Not enough, not enough. So we cannot aim to have a stronger growth rate in the future if we are not really investing in research and development. And of course, research and development, you can do it at the private sector, but you have to do it also at the university. And look at the quality of our institutions, universities, across the region. Few of them in the top rating. Whatever rating you take, we're doing very poorly also on education in Latin America. Therefore, we cannot expect very great innovation path if we rely on this type of education in our countries. We did something. We tried to grant after 200 years almost. It was the last time that the government in Paraguay financed people to go abroad and study a master's degree, PhD, and right now postdoc also abroad. Not only that, but the Paraguayan government was sending school teachers abroad in order for them to learn and to go back and improve the quality of institutions in Paraguay. What are the requirements for that? You have to get into the best 300 universities in the world. Now we're going to decrease that. It's going to be less than that. And then the government pay full tuition and all the other expenses. This is the way to go. It's not much, but for Paraguay, having more than 1,000 people studying abroad, when all these people come, and plus the other people who are going abroad this year and next year and the following, this will imply a large impact in our quality of education, because the teachers are coming to teach over there, and on the quality of the professions, because all the people who are going abroad for master and PhD are going to go back in Paraguay. So this was a strong commitment to human capital formation there in Paraguay. Now finally, the final I, that for me is crucial in the future. Inclusion. And here I'm going to talk about two types of inclusion. One is financial inclusion. We saw before that the size of the financial sector is quite small relative to other parts of the world. If you look the microdata, here is the count of financial institutions in Latin America compared to OECD, or loans granted by financial institutions in the last 12 months. It's very small still to what it happened in other regions in the world. Now, it's easier to say than to get financial inclusion. Let me tell you that because I was involved in this financial inclusion process in Paraguay. It's not that easy. But there is one thing that, at least for Latin American countries, will be quite important. And it's this one. This one in Paraguay is less of a telephone and more, yes, of course, you do Facebook, you do many things, but this is also a wallet. This is an e-wallet. In Paraguay, given that it's not possible to open a branch, like in every corner, you need to find other ways so that the people can have at least basic access to financial services. And with this one, you can get it. Really, this is a powerful in order to transfer money first, that is the way it starts, but then also getting loans or save. It's incredible how powerful is this. It's very nice experience in Asia, in Africa, in Kenya, Tanzania, and so on. But also in Paraguay, we were able to really deliver more financial inclusion using technology, using the phone. Just to mention one number, there are more than 1.3 million users of e-wallets in Paraguay. In the financial sector, there are 800,000. So it's 50% more people using this transfer money to save than in the financial sector. So we need to really bet on this, and this is something that we're talking a lot with other colleagues, central bank colleagues, about how to really use the technology in order to grant access to the people. Just one thing, imagine the data they have. If you have data on transfer, imagine initial condition. Initial condition is always put money here and transfer to your friend, to your employee, to whatever. That data showing how much money you transfer each month is extremely important, for example, for the bank to grant some loans to the people. You can see the financial movement of one guy looking at the data here. And that allows you to give you, to grant some loans to the people. And right now, banks are started to work with the telecom companies in order the joint efforts in order to really use the data of telecom in order to really see what people are going to be able to receive a loan and the limit for that loan. So we need to bet on technology to facilitate the access to financial sector. The other inclusion I want to really present today is woman participation in the labor force. Probably so far we didn't want them to really participate because we have a demographic boom where we have a population growing, so more people coming. That is going to stop at the peak and then it's going to start reversing. Then you need for growth, as I showed before, more capital, more productivity, and more people working. But if you see population going down, who is going to work? And there we need to really encourage more women participation. Latin America still is doing poorly in participation of the woman at the labor force compared to other regions and compared to the men participation. There is still a very large gap. There is more gap in South Asia, but the gap in Latin America is more than 20% in labor force participation between male and female. So this is going to be crucial in the future in order to deliver really the more labor that we will need down the road. So we did some progress on financial inclusion. We don't have that micro data to see how women are participating in Paraguay, but there has been some progress in Paraguay recently regarding financial sector inclusion. So final remarks. Golden years, again, are over. It's not going to be easy going forward. So we need really to sit and start designing all the policies we need to deliver a stronger growth rate going forward. We cannot depend anymore on the exogenous factor for growth. We need to really focus on policies that will deliver structural changes in our economy in order to grow in the future. I presented 5 I's. Probably there are more I's than those that I have presented, but I think those are going to be crucial in the future to really start increasing the growth rate again that decelerated recently due to the commodity price growth. It's not going to be easy, and the more difficult part is to convince those who are going to take the decision into changing those I's. Why is that? Because those are not reforms that are going to have a result that is going to be possible to see in the short run. That are the important thing for politicians. Those are reforms that will deliver only in the medium term. And sometimes they prefer to spend in something that is easier and very quick return for the next voting instead of betting on these structural changes that really our economy needs. So thank you very much for your time.